We've already completed Marge's Sofa's job cost records. Now we get to move on to the journal entries. And the first transaction we have to journalize is when Marge's Sofas purchased $29,000 worth of raw materials on account. Of that $29,000, $24,000 were direct materials and the remainder were indirect materials. We need to record the journal entry for this purchase. So let's start with the date, which is January 1st. What we are buying in this transaction is raw materials inventory. And the amount that we are buying is $29,000. It doesn't specifically state here, but when in doubt, if you're making a purchase for a company that's of substantial size, you can always assume that it is on accounts payable. So we have $29,000 that we owe for this, and we record our description of what happened. We purchased raw materials on account. So I know that in this description right here, it says that 24,000 were direct and the remainder were indirect, even though we're putting 29,000 in raw materials. It doesn't matter if it's direct materials or indirect materials. It all goes into raw materials, but the difference between the two we're going to need later when we do our financial statements. But for now, we're done with that first entry for the purchase of raw materials. We can move on to our second entry, which is the journal entry to account for the raw materials that were requisitioned to two jobs during January. We're going to use a separate subsidiary account for each individual job, which means instead of having one work in process inventory account, we're going to have a work in process inventory account for each of our separate jobs. And it says in addition to the direct materials, to the amount that goes directly traceable to the jobs, we're going to have $5,000 worth of indirect materials that are going to get used across all jobs. Since we are a furniture manufacturer, this could be any small insignificant item that's really hard to track to a particular job. Could be things like upholstery staples, upholstery glue, small wood screws. All of these things are, no one really wants to go through the process of counting how many you use for a job, so you just use them as indirect materials. So let's start with the date here. And we have January 31st. Because we're going to use separate subsidiary accounts, we're going to have a WIP account, or a work in process inventory account, for each job. Let's start with job number 1. How much material went into job number 1? Well, easy enough. We can go and we can figure it out from our job cost record. When we go and we look in our job cost record for job number 1, we see that the amount of direct materials that were requisitioned in total down here is $2,500. So when we go back to our journal entry, we fill in that $2,500. We're going to do the same thing for job number 2. So our account is WIP inventory for job number 2. Go back to our job cost records, and we see in our job cost record for job number 2 that we had total direct materials in job 2 of $4,000 right here. So we're going to go to our journal entry and we're going to fill in $4,000. And then we have WIP inventory for job number 3. Back to our job cost records, we go to job number 3, our recliners for Springfield Retirement Home, and we see the amount of direct materials that was used in job number 3, and the cost summary was $1,000. So we go back to our journal entry and we fill in that $1,000. The last thing we have to account for is our $5,000 worth of indirect materials. And anytime it says indirect, it's always going to go into the same account, which is our manufacturing overhead account. So now, where did all this material came from that got requisitioned? Well, it came from storage, and that is where we're going to store our raw materials. So in this case, the materials that we used are no longer in our raw materials. They are getting put into our work in process. They're inventoriable costs. They're getting added to the price of our inventory. And this credit is simply going to be equal to the sum of all of our debits, which is going to come out to be $12,500. What we did here is we assigned material costs to jobs. Also on January 31st, we're going to record the journal entry to account for the labor costs of jobs during January, and we're going to use a separate subsidiary account just like we did above for inventory. In addition, we had an indirect labor cost of $3,750, and we are going to assume that all of these wages have been paid in cash. So let's fill out this entry on January 31st. Let's start with the same work in process inventory account we had above for job number 1. And if we can go to our job cost record, and we can figure out what our amount of labor cost was for job number 1. So we scroll up, we find job number 1, and our total labor cost for job number 1 was $4,250. So we go to our journal entry, and we fill in that $4,250. Let's account for our other jobs. WIP inventory for job number 2. We go to our job cost record for job number 2, and we see that we had total labor for job 2 of $6,000. So we go to our journal entries, and we fill in that $6,000. And then next up we have WIP inventory for job number 3. And we're going to go to our job cost record for job number 3, which had $1,000 right here in labor. So we're going to go to journal entries, and that's going to be $1,000. We have an indirect. Our indirect labor cost, all indirects always get put into manufacturing overhead because we can't properly trace them to one job, and the amount of indirect labor we had that's going into manufacturing overhead is given in the description as $3,750. Last line says all of these wages were paid in cash, so we're going to credit cash for an amount that is equal to the sum of our 4 debits. $15,000. Now we need to record the journal entry to account for the allocation of overhead to all jobs using our standard rate of 200% of direct labor costs. Again, we're going to use separate subsidiary accounts. So on January 31st, we're going to start with WIP inventory one more time for job number 1. And the amount that went to manufacturing overhead from job number 1, when we scroll up, is going to be equal to $8,500. So we go to our journal entry, we fill in this $8,500 for WIP inventory for job number 2. We go back to our job cost records, and we see that job number 2 had total manufacturing overhead of $12,000. So we go back to our journal entries, and we fill in that $12,000. We have WIP inventory for job number 3, and when we go to job number 3 in our job cost record, we see that manufacturing overhead was $2,000. So we go back over to our journal entries, and that comes out to be $2,000. If we're taking all of this out of our manufacturing overhead pool, we're going to need to credit manufacturing overhead for the amount of allocation. Whenever you allocate, manufacturing overhead is always credited for an amount that is equal to the sum of what got allocated to each job, which is $22,500. This is a good checkpoint, right? We know that our allocation rate is 200% of direct labor costs. Well, if we scroll up to the journal entry we already did, our direct labor costs were $12,500. No, sorry. Our direct labor costs were the sum of these numbers, which is going to come out to be, if you add this number, and this number, $11,250. Well, if you double that, it's going to end up being $22,500. So we need to fill in what happened in this entry. We allocated manufacturing overhead, and I forgot to fill in the description for the one above. In the one above, we assigned labor costs to jobs. Our next entry, we have that Marge's completed jobs number 1 and 2 during the month. So let's put this in on January 31st. So what do we do when we complete a job? Well, it is no longer a work in process. Since it's done, it's going to become finished goods inventory. And we're not going to know the amount of the credit yet, but we can easily take out the amount that we had in work in process inventory for job number 1 and work in process inventory for job number 2. To figure this out, what we're going to do is we're going to go back to our job cost records, and we're going to figure out what amount of total costs were in job number 1. So we go to job number 1's cost record, and job number 1 had a total cost of $15,250. We also finished job number 2, and we see that job number 2 had a total cost of $22,000. So in our journal entry, we're going to fill in those respective numbers. $15,250 for job 1, $22,000 for job number 2. I don't know why this didn't go into comma form, but let's fix that real fast. There we go. Which means the amount that's getting debited to finished goods inventory is going to be equal to the sum of those two numbers, and it's going to come out to be $37,250. What we did here is we completed goods. We took the costs of all it took to produce job 1 and 2, and since they're no longer in process, we moved out of work in process and into finished goods. We got a sale coming up next, and it's during the month. Marge's Sofas sold the goods manufactured in job number 2 for $46,000. These sales were on account, so the date. Let's record the sale first. Since they're on account, we are going to debit accounts receivable for the amount that we are selling for, which is going to be given in the thing as $46,000, and we are going to credit sales revenue for that same amount. So we had $46,000 worth of sales. Let's record that in our description as we sold merchandise. On January 31st, we got to record the expense now, which is the cost to us. So we're going to put that into cost of goods sold, or you could just write COGS. I'm fine with that too. What job are we selling? We're selling job number 2. So what was the cost of job number 2? Well, we just saw it a minute ago. It's $22,000. So in our journal entry, we're going to fill in the amount equal to the total cost of job number 2, which is $22,000, and we are going to take it out of finished goods inventory. Since we sold it, we no longer have those finished goods sitting around to be able to sell. So we're going to take $22,000 out of finished goods. And what happened here is we recorded COGS on sale. Next entry that we have is we have our actual overhead expenses. So what overhead expenses did we have during the period? We had accumulated depreciation of $2,850. We had rent expense of $5,000, assumed to be on our production plant. We had a utilities expense of $2,500, an insurance expense of $1,500, and we paid accounting fees worth $1,000. So all non-depreciation expenses were paid in cash. Well, let's do it this way then. On January 31st, we're going to have a debit this time to manufacturing overhead. Allocation goes on the credit side. Actual expenses, as it says right here, always go on the debit side. We don't know what that amount's going to be, so let's wait a second and figure that out. The bottom line says that all non-depreciation expenses were paid in cash, so let's record the depreciation expense first. And that's going to be a credit to accumulated depreciation equal to the $2,850 given in the description. And underneath that, we are going to have a credit to cash for all of the non-depreciation expenses. Well, how much is that going to be? We can add it up in Excel. We had $5,000 for rent. We had $2,500 for utilities expense. We had $1,500 for insurance expense. And we had $1,000 in accounting fees outside of us doing it, which in total gives us $10,000 worth of expenses, which means that our manufacturing overhead has to be debited for an amount that makes our debits equal our credits. If we had $10,000 in cash expenses and $2,850 in accumulated depreciation, we've got to have manufacturing overhead recorded for its actual expenses of $12,850. So we recorded our actual overhead costs. And in our last entry, we have Marge's sofas. They have to adjust for the under-over allocation of manufacturing overhead during the month of January. And to properly do this, you're going to need to fill out your manufacturing overhead T account. I already have it set up in here going through. I trust you guys know how to do T's. This is the point when you're going to have to do your T accounts to figure this out. So let's look at, we have manufacturing overhead right now. We have $5,000 worth of indirect materials that were used, actual expense. We have $3,750 in indirect labor, also an actual expense, and then we just recorded $12,850 in actual overhead expenses for our rent, utilities, etc. We allocated $22,500 earlier. Well, the balance of our account right now is showing as negative $900 on the debit side, which means we would have a credit balance of $900. We don't want that. This account is temporary. We need to reduce it to zero. So if on January 31st, when we adjust for this, we fill in that $900 and it brings our balance to zero. What's happening here is, if you total these three numbers up right here, our indirect materials, our indirect labor, and our actual overhead expenses, it comes up to less than what we allocated. We over allocated overhead, so we need to make an adjustment for the over allocation of overhead for that $900 difference. In the event of an over allocation, the entry to fix it using the very easy write off the cost of goods sold method is to debit manufacturing overhead for the amount of your difference, which was equal to that $900 that we just put into our T account. And our credit is going to be to cost of goods sold, again for that same $900. What happened here is we adjusted for the over allocation of overhead. So this journal entry, because we over allocated, we put too much in our cost of goods sold. When we made the adjustment, we had to reduce our cost of goods sold. That's why cost of goods sold is getting credited, because we're bringing the cost of goods sold, we're recognizing down because we allocated too much overhead during the period. If you have an under allocation of overhead, which is the complete opposite, this journal entry gets flipped. It's a debit to cost of goods sold and a credit to manufacturing overhead, because if you under allocate, you don't have enough cost in your cost of goods sold and you need to increase it. Cost of goods sold in the expense account, and it always increases on the debit side and decreases on the credit side. That's probably the hardest entry you're going to have to go through. It takes a little bit to get your mind around it, but once you get there, it's not really that difficult of a concept. With that, we're through the journal entries. Your T's will have been filled in at this point, so we can go on and do our cost of goods manufactured schedule and our income statement. And I'm going to do that in the last video. See you there.